Welcome to Sowtastic podcast. My name is Roshan Hindia, and now we continue on to part 2 of our podcast.
Perfect. So as parents who are thinking about insurance for their kids, sometimes the objection is, well, why do they need it? Sometimes they're like, hey, I know they need it, but I don't know what age is the right age for them. What do you recommend to parents that are exploring options for their kids?
What we recommend if parents do want for their children, I think the reason you get life insurance on a child is to really guarantee their insurability for the future. Like we were talking about the riders before, you are able to put on the additional purchase rider so they can buy more insurance when they're of age, 22 and beyond, till age 40 without medical questions asked.
You're locking in their health.
Yeah, so you're
in general they're best of health when they're younger.
Right. So you're really that's really the main reason is that you're guaranteed their insurability future. It's a morbid thought to think that they're going to die when they're children. That's really not it. It's really more or less to say, I'm going to give you a jump up on your own insurance in life. I'll start you with, we're now doing minimums of 50,000 to 100,000 to 150 to 200, depending upon where folks are at. Because, I remember our parents used to get the $5,000 policies on us, right? And then they were, they give them to us and we're like, really? So you want to look more ahead in 20 years and you're like, what's the purchasing power? And so most of our clients are doing like 100,000 because it's really not that expensive. It's more, like $600 a year for a permanent contract going forward. And they can put those riders on there, right?
So they can add to it.
So they can then add to it. And you're like, here you go. If you want to go buy more, you can, but no medical questions. Because if your children have a medical issue, they most likely either get rated for the insurance, would cost them a higher premium for themselves, or not get it at all. The other part of it is that a lot of parents are looking for a safe vehicle to put money for them. And so where the kids don't have Roth IRA options, right? And look, life insurance cash values are one of the last bastions of tax-deferred growth. So a permanent policy or a variable policy in that regard would be a good way for them to put money away and save in a tax-deferred environment. So once again, you're teaching them how the money compounds. You can look at that going forward. And of course, they have time on their side, right? So the longer it's in there, the better it looks, right? So if you're getting it from a quality company, a good permanent product or variable product, you can invest in an S&P 500 fund for them, right? And just let it sit in there and let it go.
And is this a managed fund?
Index. Yeah, it's like ETF.
It can be index. You can have variety.
Yeah, there's like sub-accounts of the policy, so you can do a managed account or a index if you'd like.
Perfect.
They have different companies have different things that you can do. But if you're like, well, gosh, if I can get 65 years of tax deferred growth in an S&P 500 fund and not touch it, what would that look like? Start putting away $1,000 a year for my child, and after 65 years, what would that look like with that kind of compounding growth over time, tax deferred? That's a big number.
Then we won't be complaining about that $5,000.
Yeah. So the thing is that that's the reason to do the insurance on the children. And personally, my children all have policies on themselves. It's just to guarantee their insurability. Now my daughter, who, like I said, mentioned, is 22. She got a first letter from the company saying you now have the option to buy more insurance. So we talked them through that and why they would want to do that now. She's not married or anything like that. You never know. So it's like, why don't you want to save more money? We're going to use this as a saving tool. She also has a mutual fund account and everything like that. So they go through that. And that's the other thing parents need to realize is that insurance is just a piece of the pie. It's not the whole pie. Okay? So it's not something that is albeit to one thing. It's a piece of the portfolio. And that's it. And that's another learning lesson.
It's an eggs in one basket type mentality, right? If this is making XYZ return, I just want to keep putting it into that. We always preach and teach your eggs should be in different baskets. Life in general is unpredictable, right? There's nothing that's perfect. And so that's why we say, hey, fill these baskets. And you have a better chance of success.
As parents, when they get insurance for their kids, you mentioned, first of all, riders. Can they add riders anytime in the life, or does it have to be just at the beginning?
Right at the start. And those are things that we write in there. Yeah. And these are the pitfalls when we review clients that have already done it. And it's unfortunate, but they've opted not to review it with a financial professional. They've gotten something that may have been a little bit more cost effective, or it sounded too good to be true. These are the things that we're seeing in the industry. That's the pitfalls that you're talking about, is they don't see the riders. They don't understand the riders, why they should be there. Why are you paying for them? Because every insurance company charges for those. Be it 5 or 10 or 50. Like we were talking about the inflation rider 5 years ago, it was like $15-20, right?
Yeah.
Per $500,000 in coverage. It's nothing, when you look at it. But even if you add it up over 5 years, what they added this year will more than cover that.
Okay.
Because our inflation's up, right? I mean, that's what we're seeing in some of these permanent policies is it's starting to kick in, know. But you had to wait 5 years. If you don't have that patience or that foresight to see that, hey, inflation overall has been lowest in history, you have to look and say, okay, can't go up much lower than this. And that's what's happened. It's come back.
Can we talk about mistakes to avoid when it comes to insurance? Like, for example, not focusing on riders too much at the beginning. There was a really good example that you guys mentioned prior to the podcast, which was the water cooler talk for most people. That's what decides what they're going to do with their finances, with their insurance.
Yeah, and it's always a, hey man, I got this, why aren't you getting it? And it may not be for you. It may not be the same situation. There is a difference. There is a reason they charge what they charge.
Okay.
And we have to weed through it. That's what Vince and I do, is weed through some of these guys and say, hey, these guys are going to be better in your situation and with your health. This is going to be a better way to go. And we talk to the underwriters and we go, hey, are you going to approve this? Are you going to rate it? And what rating means is that you have a certain health level and you could have 10 levels above that. And that's exponential what the costs are going to be.
Oh, I see. Okay.
So
the higher the levels, the more conditions you have?
So it can be that they charge more. So perfect example, we had a client, he wanted $1 million coverage. He had a heart attack 3 years ago. That's a level 10 because the chance of them passing him is very high.
Yes.
That's going to be the highest rating that any insurance company is going to get. There are some insurance companies, it's a denial right away. You have to weigh the costs and benefits of that.
I think the mistakes that people make with insurance in general is they don't have enough. I think they get so wrapped up in the cost of things, or get hung up on
cost, if you will.
Yeah, or get caught up in this is a ripoff, or this is an expense. They might look at analysis and say, I don't think I need that much. I'm going to do why. We don't run into that much anymore. I used to back in the younger days. That's a big mistake that I see. I also see that they don't understand why they bought what they bought. Now, maybe it was explained to them and it made sense at the time. But after that person bought the insurance, the agent was never back again. So memory fades, right? So it's just like, well, I don't even know what I have, and why did I buy this? Or I haven't looked at this contract.
Buyer's remorse,
right? I haven't looked at the contract, and I'm like, well, do you realize you're paying this expense and that expense? And I think another mistake is really researching the company that you're going with. And I think this is a good topic, is that when you're looking at an insurance company, there's a difference. I mean, do you want to go with a mutual company or a stock company? A stock company, their responsibilities are to their sharebholders first, right? So whatever they make is going to go to the shareholders and then come down to the policyholder, right? Where a mutual company, that's you own the company, right? Yeah. So whatever comes down to you. So that's a big difference, okay? When looking at insurance companies, that's a huge difference. Then you're looking at expenses and the product. What do they take when you spend a premium dollar? What are they taking out of that?
It's a mortality expenses too.
When you look at when you look at an insurance ledger, it's just a ledger. It's not actually what you're gonna. On a term insurance contract, they're only guaranteeing the first 5 years of the premium, and after that, it's if mortality rates go out of whack or something like that, it doesn't matter what they show you on the ledger. Okay, what you pay in the premium is what it is, right? But how they're going to perform is based on what they charge you for mortality and expenses.
Okay.
And if you find a company that has the lowest in those two, if they're saying, if one company says we're going to charge you $1,000 a year and the other company says we're going to charge you $900 a year for the same amount of death benefit, really, but the company with $1,000 has lower expenses than the $900 a year one, right?
Okay.
If it's a mutual company, they're going to give it back to you in form of a dividend anyway.
Yeah, but it'll be 2 years.
You're going to do better. You're going to do better paying the $1,000 than the $900, if you know what I mean. So they're going to give you a higher a higher benefit amount, a higher cash value amount because they have lower expenses, right? Okay. So that's really where, and that's getting into the nitty gritty of things. If
sounds like another podcast.
Yeah, if a client really wants to
dive into that. He's already teeing it up, man.
If a client wants to go in there,
too.
Yeah. So if you really want to do that, if you really want to look at that, and because now you're seeing all these online insurances come up, and they're like, we're gonna get for $27 a month, we're gonna give you $1 million of life insurance. Okay, that's fine, but what they're advertising to you is you have to be Superman or Superwoman to get that rate. Yeah, they're teasing. Yeah, so they probably have like 10 other rates that if your blood pressure's off or if your cholesterol's high, you're not going to get that 27. So you really want to be with more of a consistent rating group. So those are the things that let's talk about.
Another pitfall that I'm seeing is that you did apply, and you may not have gotten the proper guidance on, as far as what company to apply for. Okay, so you got a denial. So that ends up, all the insurance companies have this insurance file, right? They're going to get that record of denial. So that's what we try to steer our clients into the companies that are most likely to approve. Then the other part of this that's coming up lately, especially with your clients, is they have some older products that are paying like phenomenal yields. Do not get rid of those.
Okay. Yeah.
Holy cow. We're like, what are you doing?
So
they get letters.
The old school. Yeah. What's happening now is that some of these like old, we're not going to mention any companies, but we'll say there's some companies out there that offered these permanent whole life products when they were in that business. In their contract, they have certain guarantees, and they have to honor those guarantees. And so they're getting called by the company's agents now saying, hey, you should replace that contract with this new one.
They're getting letters monthly.
And they're getting really pressured quite hard. We're seeing this on the East Coast a lot.
And we're like, ignore it.
And just ignore it. Just keep the product you have because it's great. And it's one of these old contracts that they're guaranteeing you this. Like right now, they're guaranteeing you 3% at a tax-free environment. That's like for your bracket. That's like getting 5%. You're not putting any money in. Take it and run, and you just got to put it in perspective for people. Okay. But it's just, those are some of the things, you see these companies trying to like, oh, we can put you in a new, better product. The market's had a phenomenal run. So we'll go from this permanent product to a variable product because you're going to do better return wise. Do not do that. I'm telling you right now, do not do that. You're paying new commissions, new fees. You'll never catch up. So that's another podcast.
Yeah. And that's another part of it is, when you look at the permanent side, there's a fixed dividend based on the company's performance. Okay. Then you can do it other accounts based on the market itself. And a majority of the time we have that conversation with clients where we go back and forth and we say, do you want everything in the market? Do you want everything in just that company's profitability? You want to weigh both. You want to have a balance of both.
Right. And so it's like I said, insurance is just a piece of the pie of the overall financial plan. Your children will get involved in a lot of other things. Okay. It's just another piece of the pie, and that's the way you should view it. It's not end all be all. And I think that people get hung up on that. It's a piece of a pie. It's good to have these different funnels that you can turn on and off eventually in life.
I just, with your audience being kids, it's nice that they could have an avenue or a way to build some type of asset. Because you cannot put their name on your house. Right. Because then it would go to probate and a judge would decide what's going to happen with your properties. This is something that you can help to build their assets and something that they can have at certain stages in their life.
So that's why I wanted to ask about little known secret. I know that there are options where you can take a loan out against life insurance that you can use for investing purposes. I mean, like little things that people don't know about.
Yeah, well, now if people have sizable cash values in their policies right now, I would not do a loan. I would collateralize that at a bank.
Okay.
And
because the interest rates
are so much lower than the loan rates on insurance contracts.
Okay.
So a lot of our clients do that because if they want to go buy like an investment property, and they have a boatload of cash values, and if they don't have a line of credit somewhere else or they used up their home equity line for something else, they're like, oh, I can go get a line of credit on my insurance cash value.
So when you say collateralize, what do you mean?
You just sign your life insurance contract over to the bank.
Okay.
Yeah. So they basically then, you're saying if I can't pay back the loan, I get the cash value from the life insurance contract.
Got it. Okay.
So
very similar to when you have a mortgage, right?
The home equity line.
Pay,
like a HELOC or something.
Yeah.
If you do not pay, they have the right to take the equity, your property.
Yeah. So same thing on the insurance contract. If you have a significant cash value, because the loan rates on life life insurance contracts are high right now in today's environment. So we recommend against that. If you have a significant cash value, we recommend getting a line of credit through a bank on that or collateralizing that through the bank.
This is an asset that the banks realize, and they actually do it on their executives. They build these asset bases on them too.
Yeah, so the bank has to make sure it's a good company, a AAA rated company. Yeah, like going back to your again, and what you should be looking at, you want to look at the ratings of the company. You want to make sure they're AAA rated across the board, and that just goes to paying claims ability and managed well going forward. Yeah,
the mortality and expense ratio is important one we look at too. That's not like out there, right? Like I don't think
not many people talk about it because
it's not even on Google searches.
People just most people are concerned about what's the rate of return on the cash value,
right? And
they'll give you some number like 8%. I'm just telling you right now, nobody's paying 8% right now at all. That's a gross number before they take out all their mortality costs and expenses.
Right.
When you're looking at insurance and want to purchase a product of insurance, you really want to have a seasoned professional who's
got your best interest,
right? Who knows what they're doing. So if you get referred to somebody, or has to take that fiduciary obligation going forward, or has that background, or you get referred from other clients and whatnot, and asking the right questions. Where do you guys fall in the ratings? What are your expense ratios as compared to this company? Can you show me that? You can ask all those questions. That person should be able to provide you with all that. And if not, you could probably find it online under Moody's or Standard & Poor's or AM Best or something like that.
And that's something that's not regulated, is what percentage you can put on a ledger to say, hey, internally, you can get this kind of return.
Okay.
Well, we can put any number we want. It's unfortunate, but we can't do that because we're fiduciaries, and...
Well, they have the guaranteed rates on there, right? Yeah, they do. So, but it's just... some of the...
But you don't always see just the hype.
Yeah, it's like...
We see the 8%,
You need to understand
10%.
the ledger. You need to educate the client on that to make sure they understand that. And then it's the constant follow-up then. And that's what we do. I think the success rate is to make sure you're following up with your clients on an annual basis, 6 months, whatever it is.
Okay.
To make sure that everything, do I have a new child? Do I get a new job? And that's where the life insurance aspects change so that you're updating, life insurance too needs to be updated. People now when they hit 50, that are in the peak earning years right now, right? And they're basically now, okay, how much longer do we want to own this insurance or have this insurance, or do we need to do more for the next 10 years or so because you're going to be making this money? So do we need to maybe get you a 10-year level term contract for the next 10 years just to make sure everything is hunky-dory on the way? You techie guys out there, we are now putting life insurance on stock options.
Oh, wow.
So for you, if you know they're going to come due, if you're gone, what's your contract like with your company? When you're gone, do those still pay? I don't know. That's something we're going to have to read. So there's a lot that goes into it to making sure that you get the right number. So do they vest then and you die? And then is there an income tax that we need to pay? And how significant is that? So a lot of these folks that have, that have $5 million in stock options or whatever it is, and they're like, gosh, that ordinary income hit is going to be $1.5 million.
Unfortunately, we're bearers of bad news.
So
that number is not the in your
Do we
pocket
want to go
number.
get $1.5 million of death benefit
just to cover that
transfer risk?
Wow. Okay.
Does it make sense for $600 a year? I don't know. So these are the intricacies that happen inside the conversations with that. Anyway,
Got it. Good stuff. Thank you guys. Vince and Prit, you guys have been really informational. I'm glad you guys covered the myths. I'm glad you guys covered some interesting things that people don't think about. But overall, just thank you for giving your time, giving your wisdom.
Yeah,
thank you, Vince. Thank you.
Thank you.
Appreciate it.
Thanks for having us.
Thank you.
The ideas, techniques, approaches, information, and opinions expressed in this video or podcast are solely those of the individuals involved and do not necessarily represent those of Sowtastic LLC and its employees. While the primary purpose is to educate and inform, it does not constitute professional advice or services. We hope, however, that the content presented here will assist you in developing a strong financial understanding and mindset. You may not edit, modify, copy, or redistribute this video or podcast with any other website, computer, or playing device. Use of this video or podcast constitutes acceptance of these terms. All content of this video or podcast is subject to copyright international law. No private or public means or blog or website can repost or reproduce or modify and post its content without the written consent of Sowtastic LLC.